market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. Well, the dollar's dipping and Treasuries gaining after weak US economic data has reduced bets on a Fed rate hike next month. Let's discuss now. I'm joined in studio by Michael Metcalfe, Head of Macro Strategy at State Street. Good to see you.
Morning.
So let's start off with the Fed then. We've got Fed minutes this week.
Yeah.
How hawkish of a Fed are you expecting to come out in these minutes? Because we've had the data, none of it on Friday particularly hawkish. The inflation data kind of a relief, but still above the 2% target. If that is something Kevin Walsh claims to take seriously,
yes.
How do you think the rest of the FOMC will be talking about it behind closed doors?
Well, so actually we monitor Fed communications quite closely with an LLM-based indicator, and that suggests that the Fed has been really quite hawkish for some time, led by Walsh, actually. Walsh has always scored more hawkishly than Powell by that measure, for example. But here's the thing with the minutes. Obviously, the data we've had since the meeting has been softer.
Yeah.
And actually, already we're beginning to see the tone of the Fed by that measure roll over. And so actually the Fed is beginning, believe it or not, to actually look a little more dovish than balanced, in fact.
So do you basically write off what we read in the minutes and not expect a huge market move off the back of them?
Well, I wouldn't write them off completely because the minutes will potentially show just how split the Fed is. And we do know that there's a split across the different members. So I think there'll be information maybe in that. But there's no doubting that the recent data has lean towards being less hawkish, as you say. Yeah,
I mean, but when you look at the bond space, you've got the 30-year near its highest since 2007. That long bond auction last week during the highest yield since 2001. How much of that is Kevin Walsh letting the market do the tightening work for him? And how much is it the bond market losing faith?
Well, I mean, look, it could obviously be feasibly be all of those things.
Yeah.
So I do. The one thing that we have observed in investor behaviour for quite some time is a reluctance for investors to hold really long duration. And I think that there's a combination there. I think originally there was a concern about just how hawkish or not Walsh would be. I think he's done OK so far. But then there's the fiscal question and the sustainability of the fiscal deficits and whether anyone will ever address them.
Well, yeah.
And so this is the issue, right? So
because people are coming along back with the Sell America debate and not only citing the fiscal concerns, but also the geopolitics and the Fed communications. Is that too much?
Well, so we can measure the Sell America theme quite closely with the flow data that we have. And the answer, actually, to be fair, has been the same for the past 18 months, which is that investors are very happy to own US equities. They've been increasingly hedging their exposures to the US dollar. But they haven't wanted to hold long-dated treasuries. So it's not Sell America as a whole, but there is and to be fair, there's also selling of gilts as well. So I think this fear about duration isn't just in the US, but is notable in the US.
But does it become a problem for US tech? Where you've got AI companies having to raise money now through debt, not just funding their capex through cash flows. When does that higher rates environment start to bite?
Yeah, so I mean, so you're right. It will become a problem at some point. I think the best we can say is it's not a problem yet.
Yeah, I want to know when the crunch moment is.
Is there going to be a magic level of yields? And look, I think empirically, US equities typically start to struggle when long-term yields in the US are above 5.
OK.
So the answer would be we're not quite there yet.
Yeah, I'm just looking at the 30-year, 5.24%.
Oh, well, the 10-year, but yes.
The 10-year, 4.67. So we're a way off for now. And then just more broadly on AI, how are you thinking about that threat from Chinese players to US players?
So the really interesting thing is that for many years, AI in US tech has been the crowded trade.
Yeah.
And so it's always something that, in your year ahead outlook, you're always worried about it. And to be fair, that worry has always proved to be overdone. And what we're seeing right now is really interesting in the sense that it's still one of the most crowded trades. But in the last month, the inflows into US tech are their highest in 5 years. So after earnings, again, it's just reinforced the conviction in the trade.
Well, later on in the programme, we're going to come back to this question of the US-China relationship, particularly when it comes to tech, and how China's managing that in the run-up to the Xi-Trump summit. But, Michael, I'm going to hold on to you. We'll come back to you in just a moment. That's Michael Metcalfe from State Street. He stays with me, but let's check in on the geopolitics now, because we've got oil, as I say, fluctuating this morning as fresh fighting in Lebanon and attacks on vessels in the Strait of Hormuz cloud the outlook for a deal to end the war in Iran. Now, negotiations between the US and Iran appear to be at a standstill, and the US has said that it'll announce unprecedented economic measures against Tehran. Now, we're joined by our Bloomberg Horizons Middle East and Africa anchor Abir Abu Omar for more. Abir, I feel like I say this to you every day, but it feels like Adim's even further away than ever.
Further today, Lizzie, than before during all these previous times that we've spoken. Yes, I mean, that is true. That's been the consensus over the past couple of months or so. As a matter of fact, that ceasefire deadline for the MOU that was signed in Switzerland back in June ends today. But that was deemed irrelevant by Iranian Foreign Ministry just moments ago, saying that that deadline that is supposed to end today is irrelevant because of the multiple violations by the United States on the MOU and the concessions there. And then when it comes to the negotiations between Iran and Oman on finding that route in the Strait of Hormuz, that's been delayed, Lizzie, and that is something else that we've spoken about multiple times. Just the final stages, those were the two words that have been coming up when we talk about those negotiations that are taking place between the two countries. What we understand is that those talks are still in the final stages, that they are delayed because of, this is a quote from the Foreign Ministry, obstructive behavior and destructive elements, so probably referring to the United States there. And then, of course, you mentioned Lebanon, the deadliest attack or the deadliest strike since that June period that we had spoken about 11 people killed in Lebanon, along with a senior commander in Hezbollah. So we're seeing an escalation on all fronts, really. The Wall Street Journal, Lizzie, also reporting earlier that Iran has probably used the relative lull in the fighting to prepare for a potentially broader confrontation. They're also citing Arab and Iranian officials there. So we await for those key negotiations to take place, the ones between Iran and Oman, and then, of course, the promise from Scott Bessent about that economic isolation. We, again, don't have a lot of clarity on just how exactly the United States plans to isolate Iran economically. Would it be more sanctions? Would it be something completely different? That is something to hold for, of course.
Yeah, does he beef up the naval blockade, for example? OK, so that's the US-Iran relationship. Meanwhile, Abir, you've got Saudi Arabia, Turkey and Pakistan signing a defence deal. How significant is that?
Yeah, so this is a trilateral pact that was signed last week. According to Saudi Arabia, this will be in the prospects of defensive powers as opposed to offensive powers. Now, it's symbolic. It's called the Mecca Pact, and it has the three of the largest Sunni superpowers in the region. That's Pakistan, Turkey, and Saudi Arabia. They signed it in Saudi Arabia. So there's a symbolic value to that as well. But Saudi Arabia maintains that it has nothing to do with sects, it has nothing to do with religion, and it has nothing to do with military offensive capabilities, but merely a defensive infrastructure in the region. So this is not similar to the NATO, for example. This is just what they promised would be if an attack against any of these countries were to happen, then all the countries would treat it as an attack on their own grounds. So we await and see what exactly would happen. Of course, we've been seeing the Yemen-based Houthis attacking Saudi Arabia, some energy infrastructure and some ships in the Red Sea. That hasn't amounted to a response yet. But of course, that pact with a lot of symbolic value, especially at this time with the conflict in the region escalating by the day, it looks like, Lizzie.
OK, Abir, thank you so much for the update. That's Bloomberg's Abir Abu Omar out of Dubai. Well, let's bring back in Michael Metcalfe, head of macro strategy at State Street. And Michael, I'm just looking at some comments from Iran's foreign ministry this morning saying that 60-day deadline in the Memorandum of Understanding lost all relevance because US violations meant negotiations for a permanent deal never began. today was the expiration date regardless. I wonder, when you've got talks deadlocked like this and Brent up 6% last week, how much that inflation is a wild card for the Strait right now, and how much the Strait matters for more broadly your positioning in markets.
Oh, I mean, look, the pass-through from energy prices is continues to be a significant threat. I think markets have been lulled into a little bit of complacency because of what we've seen so far. Which is that higher fuel prices pass through to headline inflation immediately. But core inflation has been benign. And the interesting thing, obviously, the July inflation prints were probably too soon to capture the rise in energy prices that we've seen since concerns about the conflict restarted. I can tell you, we've already got a little bit of data for August from State Street price stats, and it's much firmer. It's up about 30, 40 basis points already in the first 10 days. And so what that tells you is that the headline inflation isn't going to be quite as comforting. And of course, the risk is that eventually, if headline inflation remains high, that it finally bleeds through into core, which it hasn't done yet. Yeah,
and if you take it in the UK context, we've had the likes of Ian Seeley on this programme in that seat saying that it doesn't look like the Bank of England's in a rush to hike rates. Yes. But then we've got inflation data this week expected to rise, I think for the first time in 4 months. You've got the Iran impact maybe going to show later on in the year. Do you think that the market's underestimating how hawkish the BOE is going to be?
Well, so it's interesting, obviously, because the UK, with its energy price cap, almost deliberately delays the impact. And so actually the rise in energy prices that we're seeing right now probably don't come through until September. This is the first lot that's coming through. I think the BOE is in a slightly different position to the Fed because our economy isn't quite as strong. Yeah. And so that gives them a little bit of a pass, I think, in terms of needing to tighten. But I think you're right in highlighting this kind of stagflationary risk where you have softer growth and higher inflation is probably the scenario that is underestimated by markets right now.
But then from the gilts perspective, how do you factor in the Burnham effect? Because it feels like gilt markets are giving him a bit of a pass at the moment. But do you think that this poll lead that Labour has now reclaimed is giving the market too much confidence?
Yeah, I mean, again, there's clearly a risk of complacency here because there's been very little. I think if you'd said at the start of the year you're going to have a massive shock to energy prices driven by war in the Middle East, and you're going to have a change in government in the UK where are gilt yields, you wouldn't have them here. You'd have assumed that there'd have been a much bigger dislocation. But I think obviously the test, and this is just pure wait and see. We're going to have to wait and see the detail of the budget to figure out what, But I think until then, everything, at least the market is giving them the benefit of the doubt.
Well, that'll be October the 28th.
Yes, it's a long way.
Yeah, we're told we're not going to have all the leaks that we've had in previous years because John Healey, the Chancellor, is going to try and tighten up security around that. Is it the case that you think we'll see less volatility in the run-up, but maybe a drop-off for gilts off the back?
Well, yes, there'll be no leaks, but there'll also be, the fiscal version of forward guidance, I'm sure, where I'm sure they'll detail, if they are going to do small tweaks to the fiscal rules, that will be out well in advance, so there's no shock. Exactly.
OK. Just finally, we've heard many people on this show saying that 60-40 is dead. Do you agree with that? And if so, what are the other options?
Well, so the one thing we capture very clearly in our asset allocation metrics is that because of this desire not to hold duration, the underweight in bonds is really significant. And so I think, and part of that is the long-term inflation concerns that we've talked about, but also, the fiscal issues. And so, the alternative then, if we're assuming that we're in a more inflationary environment, is real assets. But it also, I think, explains the really big overweight and concentration in tech, because that's assumed to be a structural, not a cyclical trade.
OK, great to see you, Michael. Thank you very much. Michael Metcalfe there, Head of Macro Strategy at State Street. Well, coming up on the Pulse, Germany is said to be weighing a potential sale of its stake in Commerzbank to UniCredit. We'll get you more on our scoop next. This is Bloomberg.
Next week, Bloomberg is live at the Jackson Hole Economic Symposium. Tom Keene and Lisa Abramowitz, along with Michael McKee, will bring you news and interviews with Fed leaders, policymakers, and economists shaping global monetary policy. Tune in for continuing coverage and a special episode of Surveillance, August 28th at 9 a.m., including full coverage of Kevin Warsh's first speech to the conference. The Jackson Hole Economic Symposium on Bloomberg. Context changes everything.
This is The Pulse. I'm Lizzie Burden in London. Now, some of America's biggest investors have revealed their latest holdings, including their bets on SpaceX after its record IPO. Quarterly filings show hedge funds including Millennium, Coatue, Davidson Kempner bought in alongside Nvidia with $21 billion stake. Let's bring in Bella Farr, our Bloomberg finance editor, for more. Bella, this is the first look, really, at who bought into SpaceX's IPO. Which of those stands out to you? Because some people are making big money here.
So obviously, Nvidia's $21 billion stake, it's really hard to ignore that. And, you know, what's interesting is that we got, for the first time, first-time investors that came in into the IPO, but we also got a look at, some of the firms that had invested a long time ago. So NVIDIA had actually bought a stake in XAI, which SpaceX, acquired, and now that stake is worth $21 billion. So, obviously in June we spent a lot of time talking about the retail interest in SpaceX. There was a lot of it, given Elon Musk. But this is the first time that we're actually seeing institutional holders and what they bought into.
OK, and we also, of course, got the latest filings from Berkshire Hathaway, which we always pour through in great detail. What did they tell us? So, the market is really watching to see what the new CEO, Greg Abel, will do. And so far, it just seems like doubling down. They added to its stake in Delta and Alphabet. Alphabet now is the third largest Berkshire holding. What's interesting is, and I want to make note of this, is that there's no SpaceX holding in there. Yeah, why?
Unlike everyone else. We don't know yet. I guess we'll see if, they buy into it eventually. But, I think that doubling down is the way that they're going right now.
All right, Bella, thank you very much. That's Bloomberg's Bella Farr on the latest 13F filings. Now, Bloomberg has learnt that senior government officials are open to discussing a potential sale of Germany's 12.7% stake in Commerzbank to UniCredit. That's if the two lenders can agree on a joint strategy. Now, a spokesperson for the German government said that it hasn't changed its stance, declining to comment further. So let's get analysis on what we do know with Bloomberg's Tom Metcalfe. So this is a good scoop, Tom. Does it make a deal between the two banks even more likely now?
Yeah, I think so. So, look, it's a long-running saga. There's a lot of time still to go. But I think for me the biggest takeaway is Berlin, totally understandable given sort of the lay of the land, is now taking a much more sort of, I guess, pragmatic approach. Previously the messaging was very, very sort of virulently anti-UniCredit. What it basically seems like the stand-in thing would be now, if the two banks can agree, sort of how they might proceed, assuming, and obviously they'll be thinking of this, assuming it's satisfactory for Berlin, i.e. protect German jobs or find some ways to make sure that Berlin can sell it to the German people, then it doesn't sound like this big 13% stake that Berlin has will necessarily be used to block anything. It will be perhaps kind of wave it through.
Well, yeah, you talk about some of the terms there. When I spoke to Bettina Orlop, she really did not want to go into what those terms might be. So what are the next stages then? What are the next steps?
Yeah, I think, it will go into effectively bilateral talks, as it already is. And right now, the first talks are much more sort of technical and sort of fairly incremental about how, UniCredit effectively owning 48%, how they should kind of adjust for that. Where it'll get really interesting is, just when they sort of bluntly get to where will the HQ be? What kind of shape do we want this deal to be? Because to be clear, it's, when I think of a takeover, I always think most simple kind of, hey, one bank takes over another. Yeah. There's a whole spectrum here that the two sides could do perhaps if it works well for both of them, or they feel that's the sort of most efficient way to get this deal over the line.
Yeah, and who runs the show, who keeps their job. All right, let's just come to the latest commentary from Jamie Dimon. He's been warning the Chancellor, John Healey, apparently, against higher taxes on banks. This is a call last week. The FT's reported it. But I feel like I've got deja vu. I feel like this has been something that Jamie Dimon has said several times over the years. What's different now? What more do we know?
No, I think it's that. It's same sort of same tune, right? And, it's kind of a reflection of just how many chancellors there have been over the last few years that it sounds like deja vu. This is absolutely what you'd expect, any bank CEO to come in when they're meeting the UK Chancellor.
Is it hyperbolic, though, to suggest that banks will leave?
I think that's where, where is that line, right? I think, yes, personally, the banks recognise UK big market and certainly has plenty of issues and they don't want to be taxed higher. But I think that would be an incredibly drastic response to, whatever a reasonable government would look to do, I suppose. But yeah, huge area of concern for the city.
Tom, thank you very much. That's Bloomberg's Tom Metcalfe. Now, the next generation of chief executives will need to spend more time building flexible organisations. That's as the deployment of AI rapidly reshapes how companies do business, according to Harvard Business School professor Linda Hill. On the latest episode of the podcast Leaders with Francine Lacqua, Hill explains why today's most successful executives create organisations that can adapt to constant change.
I think the CEO is different because of to the extent that it really matters nowadays that you build an agile organization that can adapt.
To anything.
To anything.
Because the news is so formidable.
Right.
And it changes by the day.
Yes. Somebody down there is going to hear it sooner than you, and you want to make sure you've empowered them enough. I mean, there has to be guardrails here and things that they will make the decision that's the local decision that needs to be made at that time. And or they will understand they need to escalate to you. So really one of the things that I first work with when I'm working with CEOs is decision-making rights. Being real clear who has decision-making rights for what, and what do you want to hear before they make the decision, and how do you need to set up the way you work so that you're comfortable having delegated that to that person or that group of people to get done what needs to get done. The other thing that very senior people don't necessarily talk about, and I understand it in some ways, and even boards, they don't talk about risk. Really, they can have very different risk appetites. Oh, yes, they can have very different risk appetites on the board, but they don't ever really address the fact that they have different risk appetites, and it just sort of plays out.
What, amongst board members?
Even as board members. No, because I don't think board members like to have conflict. Conflict is complicated. So sometimes, and we've all been in situations where do we bring it up or not? It's there, whether you bring it up or not, and it's going to play out in different ways. But I think CEOs or board chairs or lead chairs understand that, nowadays, given what's going on, we need to talk. We need to say, what is our risk appetite as we begin to, for instance, roll out AI solutions? And that conversation is a really hard one to have. I mean, I work with some of our board programs, and how do we have that so we don't make that person look like, oh, you're too conservative or you're resistant to the future?
And you can listen to that episode now wherever you get your podcasts, and you can also catch it on Bloomberg TV later today at 10 p.m. London time. Well, coming up on the Pulse, China's economy, tech ambitions and foreign policy in focus this morning. Plenty to discuss. We'll be speaking to Yu Jie from the Asia Pacific programme at Chatham House. That conversation coming up next. This is Bloomberg. Happy Monday and welcome to The Pulse. I'm Lizzie Burden in London with your top stories. The dollar falls and Treasuries gain as traders trim bets that the Fed will raise interest rates after weak economic data out of the United States. Oil fluctuates after fresh Israeli strikes on Lebanon. A US threat to leave Iran economically isolated heightens the uncertainty for a deal to end the war. Plus, China's economic woes deepen as data show the economy got off to a sluggish start in the first half of this year. Well, that is where we're going to pick up. Chinese President Xi Jinping warning of, quote, high winds and rough waters as China faces slowing growth and rising tensions abroad. Xi invoked the legacy of his predecessor, Jiang Zemin, to advance his own economic and political global agenda. The Chinese leader was speaking at an event marking the centenary of Jiang's birth.
The whole party, the entire military and the Chinese people of all ethnic groups must rally more closely around the CPC Central Committee, hold high the great banner of socialism with Chinese characteristics, remain confident, and strive with determination to advance the cause of building China into a great country on all fronts and realizing great national rejuvenation through Chinese modernization.
Well, we're joined now by Yu Jie, who is a Senior Research Fellow for the Asia-Pacific Programme at Chatham House. Really good to have you with us this morning. Thank you for making time. I wonder what you made, then, of that speech from President Xi, because it seems really significant, and you've pointed this out, that both of those figures were key to delivering China's economic reform, both of them key to China's entry to the WTO. At a moment when we've got a trade war between the US and China, what does invoking that era of globalisation and reform say to you about where Xi wants to take the country?
Well, I think there are three things that Xi Jinping wants to use this occasion to. Firstly, to commemorating the predecessors, which laid the economic foundation since China joined WTO. But secondly, I think more importantly, Xi Jinping wants to give a very strong signal both for the domestic audience as well as the foreign audience. That is to say, China is still very much keen in terms of having a reasonable economic performance in order to sustain the party and in order to sustain is kind of a performance legitimacy. And now, thirdly, I think also significant part of his speech and also mentioning something to do with the great power relationship that Jiang Zemin and his predecessor and his team managed back to 20 years ago. And equally, and Xi Jinping wants to tell the rest of the world, and he's also capable of managing that legacy. He's also capable of managing the great power competition with the United States at the same time. So these are the three things. Even though it is about remembering the deceased, but equally it is about laying his policy outline in the months and years to come.
We also had the latest China data out this morning. The time shifted to accommodate that speech, and we're going to dive into the numbers in a moment on the programme with our reporter Rebecca Chung-Wilkins. But the overall picture was that the economic woes are mounting in China. And I wonder, as we gear up for the Trump-Xi summit in September, if that leaves the leverage of Beijing weakened, or actually if it makes Xi even more determined to hold his line, for example, on tech.
I think really judging from the 15th five-year plan Beijing published a few months ago, it's very clear indication that the pain threshold in terms of economic growth become much higher, and hence a significant amount of national resources will be pivoted into the pursuit of technology self-reliance. And that is also something which Jiang Zemin and Zhu Rongji advocated back to 30 years ago, if we're talking about commemorating these two predecessors of Xi Jinping. So I think that's been very clear, and irrespective the economic index for each quarter may not looking so illustrious, but instead Beijing's focus will be remain within the technology competition with the United States, and irrespective what is the outcome for Xi-Trump summit in September, and that principle will not change.
OK, really interesting to draw that historical comparison. As we head towards that summit as well, we've had, what some might say is posturing For example, President Trump imposing those 100% tariffs on imported drones. China, the world's biggest drone maker, of course, so this is where it's going to hurt. But China flexing its legal muscle as well. How much is all of this, as I say, posturing? How much is it just pre-summit theatre? And how much is it the two sides actually genuinely drawing up red lines?
Look, I think it's less of posturing. It's less of just political signaling, but instead, I think this is the signal to both the foreign investors, but also for the domestic companies. That is to say, Beijing are far more willing to use tough and punitive measures when they come to export control, when they come to control its supply chain. And I think that's a step-by-step Beijing has been built up in the recent years. And in a way, that is a key lesson China has learned from the United States by imposing a very stringent export control on its own high-end technology manufacturing products. So I would not be really surprised to see this only as a posturing, but also considering what Xi Jinping discussed with Donald Trump back to May summit, talking about so-called strategic stability. I think part of the strategic stability, it is really revolving around how the two countries is going to manage that AI competition at the same time. And so far, that has not really been laid out yet. So we shall wait and see, and what will be more detailed discussion between the two men in late September.
OK, so it's not just posturing. They've got to figure out their relationship on tech. They've also got to figure out their relationship when it comes to the Middle East. And we've had the US Treasury Secretary Scott Bessent warning that there's going to be unprecedented economic pressure from Washington on Tehran. China's kind of in the middle of it. One option, of course, would be sanctioning Chinese banks that finance Beijing's purchase of Iranian oil. How much of a tripwire is that for the summit as we look towards it? How much of Chinese energy security, we know that it runs through this, so how much could that impact the US-Beijing relationship if the US is pulling the Middle East in?
Well, I think so far Beijing has managed to cushion this, the crisis in the Middle East far better than many of the developed economy. I think precisely because of its supply chain regarding renewable equipment, precisely because the amount of oil reserve that Beijing is having so far. Now, the issue in here is less about economy. It is more about the politics. It's to what extent that China wants to get involved in the crisis in the Middle East. I think for now, Beijing's responses has been quite timid. So irrespective of whatever the request the Trump administration may able to make to Beijing, and Beijing may have to reassess this according to its own national interest, and may not really feel is really need to get involved as such at all. So I think for now, yes, Trump administration has been spoke quite a lot to asking Beijing in terms of step in. But I think for now, the responses will continue to be very timid. And also Beijing realized this is the chaos that the Trump administration has landed within itself. And hence, once your enemy make mistakes, and you try not to disturb your enemy at the same time.
Wise words. Well, as we look at the potential options available to Bessent, at what point does the Middle East become an issue that derails the September summit? Can you point to where the red line is, that it's not just something that would complicate this summit, it would actually blow it out the water?
I do not necessarily consider the crisis and war in Iran would be the red line for Beijing in terms of potentially blow up the summit, but instead, I think it's the responses regarding Taiwan, and Xi Jinping and the Chinese will watch this very carefully, that what exactly the Trump administration want to do, and also what exactly the Trump administration is saying related to Taiwan. And I think that will be the clear red line to be drawn in terms of whether this September summit is going to take place and what are the key contents for that.
I thought this was a really interesting line. It's from Bloomberg Economics. Unless the president decides to prioritise addressing the Iran threat over all other issues, and namely China, it's unlikely any action they take is going to materially change Iran's calculus. Yujia, it was really great to talk to you this morning. Thank you so much for making time for us. That's the Senior Research Fellow for the Asia Pacific Programme at Chatham House, Yujia. Thank you. Well, disappointing economic data, as I say, out of China today, reviving pressure on policymakers to act in support of growth, as we've seen industrial output, consumption and investment all faring worse than expected. Let's go now to Rebecca Chung-Wilkins in Singapore for analysis. Rebecca, China's economic troubles mounting. What are your key takeaways from these numbers?
That's absolutely right, Lizzie. I mean, pretty disappointing across the board. And a couple of numbers to really zoom in on here. The first, I think, industrial production. We were expecting a bit of a setback because of these really extreme weather disruptions that we've had, sort of typhoons, rainfall, the likes of which we haven't seen in these major manufacturing hubs in China for decades. That disrupted factory production. It disrupted functioning in ports. So we were expecting to see that pain kind of trickling through. And yet still, that was worse than expected. And again, the other key element here, retail figures coming in, sort of somewhere close to 0.5% or so. Back in May, we saw that figure shrink for the first time since the pandemic. Since then, it sort of stabilized around sort of a lackluster number of 1%, 0.5% or 0.6%, really still very disappointing for some. And it does underscore the challenge for policymakers now having to stimulate both this industrial production and that domestic demand. Worth quickly, I think, flicking to just a couple of other figures that are sometimes sort of slightly less looked upon. The first is that fixed asset investment number. That number, that rate is falling faster than anyone can really explain. We have yet to see economists provide a kind of really legitimate or kind of rationale for why that number is falling quite so fast. It's quite a puzzle. And the other is that unemployment number. Now, we had sort of stabilized around the sort of 5.5%. It ticked up a little bit. And the spokesperson did kind of hint at that is coming from more from sort of younger folks. So it's worth just now looking forward to that unemployment figure for youth that will be coming down the line. We have a record number of graduates entering the job market at the end of this summer. So another number that's worth kind of keeping an eye on and seeing whether we get back to that 20% figure. That was a number we had reached a few years ago, you remember, before they changed the method of calculating that figure. But anyway, yes, gives us that kind of forward-looking momentum now to see where this weakness is showing up elsewhere in the economy.
And Rebecca, we were discussing the Xi speech this morning, talking about maintaining that momentum unleashed in the Zhang era. What do these numbers that we've had out today mean more broadly for that continuation, for China's recovery efforts?
There's a big question over whether we see more stimulus, essentially. That's what it all, I think, ultimately boils down to. But as Yujia pointed out, there is this extraordinary tolerance for pain that President Xi has demonstrated and in some ways kind of reaffirms in the kind of very clear historic parallels that he drew in the speech this morning. There has been chatter about whether we are going to see this deja vu flashback moment to 2024 when we saw this really coordinated effect from all these different institutions around China to support and stimulate the market. We are in a very different situation now where I think by and large the consensus is we are not going to see that type of broad-scale stimulus even with the figures at the level that they're at. And there are a couple of reasons for that. One is the fact that there is still more room to issue government debt to try and support that through infrastructure. And so there may not be so much inclination. The second is that exports still have stood up fairly well, given all of the external pressures. And so we don't see that same kind of urgency or motivating power yet. Saying that, if we do see any stimulus, the consideration is probably that it may come through in September. That is when we saw that later stimulus package from 2024 announced. We do tend to see these kind of stimulus packages and these announcements happening in the fall in China. So there will certainly be a sort of investor focus. But despite the shift in tone that we've seen, Yujia pointed out this as well, despite a slightly more positive shift in tone we've seen from policymakers, we still see them really falling short of actually taking many concrete measures. And economists sort of at this point saying that even if we see those, they will be sort of relatively measured and a sort of different style from what we saw a couple of years ago.
OK, Rebecca, really appreciate your coverage. As always, Bloomberg's Rebecca Chung-Wilkins there. Well, staying in Asia and turning back to the geopolitics, President Trump has told the Pentagon to, quote, substantially reduce joint military exercises with South Korea. It comes as the conflict in the Middle East has strained relations with some key US allies. So let's get more now with Bloomberg's Rosalind Matheson. Ros, why is President Trump scaling back these exercises with South Korea then?
Well, there's possibly a few reasons, and it might just be that someone mentioned this in passing and happened to say, by the way, these exercises are about to begin, and that got his attention. These quite sizable drills are about to begin. But he did mention a couple of things in his statement on social media. One was the North Korean leader, Kim Jong-un, and saying that he had a very good relationship with Kim and it would be an inappropriate signal to have these drills continue in their current form. And it's interesting because, of course, there hasn't been a lot of interaction, it seems, between the US and North Korea in this Trump administration. We had two summits, of course, between them in the prior administration, and then things really kind of fell apart between those two leaders. And there's no great sign there's a lot going on behind the scenes, but perhaps Donald Trump wants to re-up those conversations and restart a dialogue with North Korea, which is something that South Korea, in fact, China would also welcome. So perhaps there's that. He also did touch on the Iran question. He linked them a little bit, saying, of course, that South Korea was one of those countries that he said had declined to help the US when it came to the US and Israeli war in Iran. Of course, South Korea, as one of those US allies that quite clearly did not want to get pulled in militarily. So he's linking those things, as in, you didn't support us, so why should we expend all this military firepower on these large drills with you? And there's possibly even an economic imperative here, which is that the US and South Korea are engaged in these conversations around large-scale strategic investments by South Korea in the US. There are some reports that America is feeling those talks are going quite slowly and it wants to push South Korea along a bit. So perhaps there's a whole lot of reasons bundled into one.
And how worried do you think that other US allies in the region in Asia should be because of this? Do you think that it sets a precedent perhaps for other countries other than South Korea?
Well, certainly they're all watching it really closely. I mean, this does seem to have blindsided the South Koreans. Initially, earlier today, they were saying the drills are going as planned. Now they're saying, oh, we're having conversations about it. So clearly taken a bit by surprise there, and no doubt anxious to avoid this blowing into something bigger, because for South Korea and others in the region, Japan, Taiwan, no doubt also watching this very closely. There's that broader sense of unease under the Trump administrations, both of them, about whether that ironclad commitment is really there. Can you count on the US militarily, if needed, to come to our aid? Is that still something we can presume will happen? And so is Donald Trump again, letting that fray at the edges, those understandings? And so if you're Japan, if you're Taiwan, and South Korea, obviously, you'll be watching very closely to see, is this just a late night musing by Donald Trump, or is it something more fundamental?
And indeed, European countries asking themselves the same question: can we rely on the United States? Bloomberg's Rosalind Matheson, thank you very much for your analysis. Well, coming up on the Pulse, firefighters in Belgium battle to contain a record blaze near the German border. We'll get to the weather next. This is Bloomberg. This is The Pulse. I'm Lizzie Burden in London. Now, checking in on Brent crude, which has been fluctuating after gaining 6% last week. Currently trading at $88.84 the barrel, up 0.4% on the day. But it follows the deadliest day of fighting in Lebanon in months and fresh attacks on vessels in the Strait of Hormuz. Talks to end the Iran war have all but stalled, and the United States is now threatening fresh economic measures against Iran. With me now to discuss the impact on the oil market is Bloomberg's Will Kennedy. So, Will, I've mentioned that Brent's under $90 a barrel. It feels like we're in a tight range here, and we have been reporting that part of that comes down to these covert Middle East oil flows. Is $100 a barrel, according to the people you speak to, kind of off the table now?
I wouldn't say it's off the table. As long as the Strait of Hormuz remains a zone of conflict, it's possible that the world ends up short of oil and that we do see significant pressure on prices. But what we've certainly seen this summer is that the market is currently coping to a large extent with what's going on in Hormuz, and that's happening in a couple of ways. It's happening because of these pipelines that bypass Hormuz, both through the UAE and Saudi Arabia, which we've been talking about for a number of months. We're also seeing an increasingly sophisticated and successful operation to shuttle oil out of the Persian Gulf on short-range tankers that load up inside the Gulf, turn off their transponders, stick close to Oman, get out, and then transfer their cargoes into ships in the Indian Ocean and sail to destinations around the world. And I think that traders are recalibrating just how much oil is involved there. The US Energy Secretary, Chris Wright, said 9 million barrels a day at one point last week. That may be on the high side, but people think it's certainly running above 4 million barrels. So it's a long way from the 20 that we saw before the conflict, but it's very significant, and that's what's keeping prices under control, I think.
OK, Will, thank you very much. That's Bloomberg's Will Kennedy with the latest on the oil markets. Now, turning to the weather, emergency services have been working to contain a major wildfire in eastern Belgium, which has already destroyed nearly 3,000 hectares of a nature reserve near the German border. Let's go to our chief Europe correspondent, Oliver Crook. He joins us now from Brussels. Ollie, we've reported on wildfires across Europe this summer. You've even been to the Rhine with the lower water levels. Just bring us the latest from this blaze.
Yeah, absolutely. In the season where it's really supposed to be a quiet news time for the Europeans, and certainly here in Brussels where the EU basically goes to sleep, it is now being revived by all of these stories of the effect on the climate that we're seeing really universally across Europe, and now really reaching Belgium, where you have the worst ever recorded in modern history wildfire still currently blazing in the east part of the country. It is moving in the direction of Germany. It has been mostly concentrated in a forest and a nature reserve there. You can see it on the map there on the eastern part, but again, steadily advancing towards Germany. It has caused hundreds of people having to evacuate in Belgium, some having to evacuate over in Germany. We've also got an update that the Germans have been sending their army in to help with the Belgians to put their efforts out to put this fire out. There's also some good news that we got a little bit of rain this morning in the region and across Belgium, which has been helpful, but the officials say not quite enough to quench the wildfires. And of course, it is something we're watching in Belgium, but Lizzie, we're watching it in the United Kingdom, as you've been watching very closely. We've been watching it across France, across Spain, across Greece. Still very much an active conversation. Is a conversation that is not at all going away for Europeans every summer now.
And what is the latest on that other aspect of this, what the extreme heat means for water levels and nuclear plants, Ollie?
Yeah, absolutely. I mean, we were focusing last week on the Rhine and the effect it's having on shipping that's able to go basically from the North Sea all the way down to Switzerland. Today, we're focusing on the Danube, where Hungarian authorities have had to do a stopgap measure. They've effectively sunk 2 massive barges in the Danube in order to elevate the water level, because the water level is just so low that the nuclear reactors cannot get enough water to basically go onto the reactor in order to try to cool the reactors, and that is how they generate heat. This is something that is only going to be a sort of stopgap in the sort of interim. You still have also the Romanians. They've had to shut off their power generation. And Lizzie, this is really sort of significant for the Hungarians, because this massive nuclear power plant, pact, generates 40% of the nation's electricity. It's currently running at 25% capacity. So again, trying to scramble in all of these different ways to try to find backups in different ways for climate adaptation. And of course, still a very active debate here in Brussels about the climate change and how they're going to deal with the energy supply and not burning fossil fuels. But more and more, Lizzie, a focus on adaptation and just dealing with the consequences that we can basically no longer avoid across the European continent.
OK, Bloomberg's Oliver Crook, thank you so much for the latest there on the climate that we are seeing across the European continent and indeed around the world. Well, let's just check in on the futures picture as we head towards the Wall Street Open, shall we? S&P E-minis up 0.1%, Nasdaq futures up 0.5%. So following on from the gains that we've already been seeing in the European cash session, the Stoxx 600 up 0.1%. And indeed, building on what we'd already seen in the Asian session, the MSCI Asia Pacific Index up 0.3%, despite Korea being on holiday. Tech driving the gains. The Hang Seng Tech Index up 1.6%. Well, up next, Bloomberg Brief. That does it for the Pulse. This is Bloomberg.